Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and the Silicon Valley Bank collapse has sent shockwaves across the nation, specifically across the West Coast states. Now, here's the thing. We shouldn't be surprised about this because when things break fundamentals, again, when things break fundamentals, they fall apart, just like the unaffordability in the housing market. And that's why I continue to sound the alarm to you guys, because again, what we should have learned and what we should be learning now with the total devastation of the banking sector is when fundamentals do not work, it will fall apart, just like the housing market will also fall apart. However, we're beginning to see massive negative effects as a result of quantitative tightening in tech-heavy areas, especially out in the West Coast. Tech failures alone out in the West Coast, topped with unaffordability, is crashing the housing market at record speed. Because not only are they experiencing massive job losses, those areas are overinflated as a result of excessive purchasing through COVID, topped with low interest rates. So all of the unaffordability out in the West Coast is finally starting to catch up. And again, that's going to continue, you guys, to magnify as unemployment continues to spread, just like what's happening with Facebook. You probably saw that Facebook plans to lay off another 10,000 workers, Mark Zuckerberg, as chief executive, has declared. It's not just Facebook. All of these tech-heavy areas are getting absolutely demolished. So today we'll jump into an article from Fortune magazine. We'll take a look at the map, and we're really going to dig into how the tech sector is leading to a housing market crash out west and also other areas around the nation. So really hope you guys like this video, because as the banking crisis continues to unfold, it will have an impact on residential real estate prices. Now, depending on where your local housing market is, those effects will be different, because what we know so far, again, just so far, is the housing market price crashing is unevenly dispersed. But I also want to remind you, similar trends and sentiment was also happening in 2008, followed by one of the worst foreclosure crises in history. So in other words, what I'm saying is despite the notion that running into real estate right now would be a great hedge against inflation, understand that the inflation is coming from the real estate market. And by investing in real estate right now, more than likely, you're going to be purchasing an asset that is maxed out, right? That is at its cap, and with an inability to go up in equity. I believe, y'all, that this is the last year that we're going to see any type of fear of missing out from buyers. When we're done with the article, I'm going to pull up Fed economic data, 30-year fixed rate mortgages, and I'm going to show you that despite the interest rates being lowered, we're still in a safe zone as far as where the interest rates are at. So we'll take a look at the historical range of interest rates towards the end of this. And if you guys can remember, I'm not a financial advisor. I'm just a normal guy that's renting right now, that's frustrated because I'm making sacrifices, I'm eliminating risk, and then over the weekend they bail out, the government bails out a whole bunch of rich people. Doesn't seem fair to me because I'm making these sacrifices now, but it is what it is. So for all of that, you guys do me a favor, please like this video, subscribe if you haven't already, but either way, let's get started on the video. So we'll deep dive into a Fortune article. The name of the article is "The Housing Market Could Face Two Big Changes in the Wake of the Silicon Valley Bank Collapse," says Zillow. This is a really good read because I really like how it's going into the tech sector, the banking collapses, and this will be linked in my description if you guys want to kind of dig into this on your own. The recent collapse of Silicon Valley Bank has sent shockwaves through the real estate industry as builders and agents alike scramble to understand what it means for mortgage rates and the economy at large. So the number one thing, and we've all started to see this because the 10-year treasury has dropped significantly. Even when I'm recording this video, the 10-year right now is down 8 basis points. So the 10-year is plummeting, as is the 2-year. But number one, it could push mortgage rates down. And what all of this is telling us and telling the market is we may have a much bigger banking crisis than what people fully understand right now. The first prediction is that mortgage rates could fall if the Federal Reserve backs off from future rate hikes. Already, financial markets have pushed the average 30-year fixed rate mortgage to 6.75%, down from last week's peak of 7%. If the Fed doesn't issue a rate hike in March, some analysts think mortgage rates would sink even further. So we didn't even make it to 4% very long. You guys remember, like on my 1-year anniversary, the 10-year hit 4%, interest rates hit 7%, and then things started breaking rapidly. Pretty astonishing if you think about how weak the banking sector actually is. Home buyers have been very responsive to mortgage rates in recent months. When rates climbed back above 7% earlier this month, it shifted momentum that had been building as rates originally drifted down to start the year. Today, falling mortgage rates could thaw what was shaping up to be a fairly frozen spring home shopping season. For buyers shopping now, especially in high-priced areas, a sustained rate drop will be a welcome boost to affordability, but they should still plan on rate volatility. And that's probably what we're going to see. We're going to see some well-positioned buyers kind of get off the sidelines and probably start buying, because quite frankly, a lot of people are sick and tired of this game. They're sick and tired of trying to figure out what's going to happen. But I just, again, really want to caution people to really understand that fundamentals are broken. And when I say fundamentals are broken, the price growth, the mortgage payments, the affordability is not matching wages. Things are way, way, way out of reach. So if we continue to have people pile back into purchasing houses, it will make the bubble much worse and much more susceptible to a massive, massive crash, because the problem is just getting worse if you go out and buy an overpriced house right now. That said, Silicon Valley's bank collapse forewarns of a looming 2023 recession. The affordability gains from lower mortgage rates could be muted by economic pain. Lower rates would help buyers who are stretched thin when it comes to affordability. But Silicon Valley Bank's troubles are indicator of a wider issues. A coming recession could be deeper and longer lasting than expected. That raises the odds that income and job loss, okay? This is what we really don't have too much right now. We have the starting of it, but the job market and labor market's so hot, we don't have too much of that right now. But I think what people are considering, here's the thing. I think what people are forgetting is what happens when the unemployment rate starts skyrocketing, right? So all of this talk about how strong the labor market is, which it is strong, and all of this talk about how there's lack of inventory and sellers aren't going to sell with 2 or 3% interest rates. If a homeowner that purchased prior to 2021 loses their job and they have $200,000 in equity and $50,000 in credit card debt, more than likely they're going to sell their house, pay off their debt, pocket who knows how much, $50,000 to $100,000, and start over again. That's what happens when we start seeing job losses. And as the tech sector, obviously, the tech sector right now is heavy, heavy, heavy in job losses. And honestly, if you think about it, one of the reasons why the overinflated prices like in Phoenix, Boise, Northern California, Austin, is because of tech jobs, startup tech companies, and all of the money that they were getting. So now that those companies are basically being destroyed, a predominant amount are being destroyed, it stands to reason the housing markets that boomed during the pandemic as a result of the tech blow up and the tech jobs, those markets are going to take an absolute beating. Because remember, not only is the employment and income being taken out of that area, those areas are drastically overvalued, drastically overpriced, and breaking pretty much every safeguard that's put into place to prevent a systematic downfall. But again, what we're seeing right now is a total abuse of all of those things. Let's hop back into the article. So job losses are coming, and it's going to hit hardest the pandemic boom towns, right? So we're going to see massive, massive price deductions in many of those areas. Let's look at number 2 now. Tech hubs should brace for more pain in the wake of Silicon Valley's bank collapse. The downfall of Silicon Valley, Olson predicts, might mean more pain awaits for tech-dominated housing markets like San Francisco, Boise, and Seattle. Western high-cost markets have already been heavily affected by the Fed's ongoing inflation fight, and the collapse of Silicon Valley Bank could exacerbate existing challenges. A widespread tech downturn might be felt in the housing market like San Francisco Bay Area and Seattle, where tech employment and stock prices have an oversized effect. With fewer home buyers in these markets able to afford the elevated prices that have been supported over the years by high incomes and stock growth, it's likely that these markets could chill and prices could come down. And again, that's why we're seeing massive price declines in some areas, and in other areas, we're not seeing any substantial price decline. So it's a little bit easier now to pinpoint why certain markets are declining and why certain markets are not. Again, tech-heavy housing markets taking an absolute beating. Any pandemic boom area that was reliant on those high-income salaries and those tech jobs, it's going to be crushed. But let me show you guys the map form right now so we can really get a better picture of just how devastating that the tech sector is having on actual home prices. Look at this. So here's the seasonally adjusted data through February of 2023. Now this is off peak, and this is according to Zillow. As you guys know, Redfin is different than Zillow, and Zillow is different than Realtor.com, but this information is from Zillow. Now, a lot of these tech jobs, as you can see here, was on the West Coast. A lot of the tech jobs is on the West Coast. So you can see by the areas indicated in red, the darker the red, the more the decline. So you could pretty much see almost every Western coastal area is taking a pretty massive beating, you guys. Pretty massive beating. Also, San Diego is down, but San Diego is really in trouble because of the lack of inventory. But look at San Francisco, Oakland, Berkeley area down 10%. Look at San Jose down 7.2%. And that's basically where the headquarters of Silicon Valley is. Silicon Valley Bank is right in this pocket right here. So as the tech continues to melt down, we're probably going to see this area specifically start melting down, as well as Boise. Look at Boise. Boise's down almost 9%. Bend, Oregon is also down 9%. That is a huge shocker. I did not think that that would drop so much. And here's Seattle at down 7%. So it's very astonishing to see this level of decline so early in the game. And these are all warning indicators, right? Here's Las Vegas is down 6.7%. Look at Phoenix down 7%. Let's look at Austin over here. Austin down about 7%. Not really seeing too much decline in Florida. We are starting to see finally decline in Florida, probably primarily as a result of obviously unaffordability, but it is declining. Whereas look at the East Coast. If you look at the East Coast, not as much declining out in the East Coast. Big reason that is less tech jobs on the East Coast for some reason. I'm not sure why there's less tech jobs on the East Coast, but you can see, look at tech heavy jobs over here, massive price declines, not as many tech jobs over here, pretty much, lot lower price declines. And look at here, you guys, look at Central. I mean, northern, look at these northern areas right here, pretty much no price declines. I'm willing to bet that there's probably almost no tech jobs in this area. And that's why that's why these areas over here are showing resilience right now. But even Colorado is not escaping. Colorado is down as well. And look at Utah. Utah's pretty low as well. Now, in a couple of weeks when I fly out to California, probably what I'm going to do is do an analysis on Riverside, Orange County, and Palm Springs. I'm starting to see some interesting things happen in Palm Springs. Let me know if you guys want me to cover those areas. So the article concludes, while lower mortgage rates could provide a welcome boost to affordability in the short term, longer-term risk associated with wider economic issues cannot be ignored. Buyers today should be looking to put down roots and find a home they'll want to keep for at least the next several years, in case it takes a while to build equity. And that's exactly what I've been warning you guys for the last year, is when we lose equity, it shackles us to the house. It traps us to the house. We can no longer refinance or sell without potentially having big losses that, in my situation, led to foreclosure and bankruptcy. I'm only trying to sound the alarm here and trying to tell you guys to be cautious. It's the biggest financial transaction of your life. But this concludes, ultimately, the fallout from Silicon Valley Bank's collapse serves as a reminder that the housing market is not immune to wider economic shifts and challenges. As buyers and sellers navigate this rapidly evolving landscape, careful planning and long-term perspective will be essential. And that is one of the primary issues right now. A lot of people are saying, because we have a lack of inventory, which we do, Overall, we do have a lack of inventory, but as a result of that lack of inventory, there's a lot of people saying that the housing market is going to remain stable and it's going to remain resilient. But these same people refuse to acknowledge the lack of fundamentals with the price, with the unaffordability. Houses right now, we're maxed out. So anyone purchasing right now, and I hate to say this because I am a realtor and I make a lot of money when I sell real estate. I've taken a step back from that because I'm saying that everyone purchasing, for the most part, everyone purchasing after 2021 is putting themselves in a high risk situation. And most people are purchasing real estate right now with fear, anxiety, and uncertainty. You don't want to purchase real estate when you have those feelings. And let me show you why it's okay if rates go down. Let me show you the tiers of interest rates historically. Take a look. All right, so let's study the 30-year fixed rate mortgage averages in the United States and see, and let me show you guys why we're going to be okay. Maybe not for the short run. When the rates go down in the short term, probably we're going to have some of those buyers, but that's only going to last so long because ain't no one could afford these houses. I mean, normal people can't afford these houses. But I just want to show you guys, this is the maxed out, look of the interest rates. We're going back to 1971. And I just want to, us to pay attention real quick. Let me zoom in here. Okay. I want us to pay attention to this tier here. Okay. This tier here. Okay. Now let me zoom back out. That tier right there, you guys, represents interest rates from 5 to 7%. Okay. So that tier right there is 5 to 7%. And I just want to point out that we have not hit that tier of 5 to 7%. We haven't hit that since the last recession. Do you guys see this? Right before the last recession and on, we had rates in that tier. But here's the thing, everything 2009, okay, on has not been in the 5 to 7% interest rate tier. The last 10 years of equity growth has been with rates under 5%. So again, as long as we have those rates between 5 and 7%, and those pent-up buyers that have well-positioned buyers are just going to go in and buy, that's going to come to a halt very, very quickly, because there's a whole nother part of the United States that's broke, has no money, and is completely priced out of the housing market, especially in Arizona. I've read reports that 74% of the natives in Arizona are priced out of the housing market. Y'all tell me, how does that work? When fundamentals don't work, things fall apart. So let's zoom out here again, okay? So I just want to show you guys where we're at. So right now, this is where we're at. Okay, so we're well in this tier right now, okay? So even if rates go down to, say, 6%, we're still in this tier, okay, right there. So what I'm really trying to say is be careful. There's a lot of narratives being pushed right now. There's a lot of uncertainty with the bank collapses, and a lot of people, including myself, are confused. But that doesn't mean we don't take into account the fundamentals being broken in the housing market, and that doesn't mean that we need to purchase real estate as a hedge against inflation. They've already broken our housing market. To purchase right now is to purchase a broken asset. And that just is not appealing to me. And that's really the point I'm trying to make now. If you're on the sideline like me, pretty frustrated, pretty heartbroken that they just bailed out a whole bunch of rich people, let this be a sign of things to come. Let it be a sign to reassure you that there is a collapse coming, and it has already begun. Now, all we have to do is be focused and keep our emotions in check, because it's really hard. I know that. I've been looking at so many houses that are overvalued. I'm like, what if I just buy this and I'm done with this and I move on with my life? I'm not going to do it. If I buy a house right now, guys, not only am I shackled to that house from 5 to 10 years, I also drastically hurt my purchasing power in the future. So there's multiple reasons why I'm not going to purchase right now, unless, again, I find the deal of my dreams, which I'm looking every single day. Now, other than that, guys, I really appreciate you watching this video. Comment below. Let me know if you kind of see the pattern here, the western states, the tech-heavy areas getting absolutely destroyed. But other than that, guys, if you're out there investing in real estate, I wish you luck, and I hope you win.